Okay, so we are on chapter 6, international trade and investment. I'm going to just just briefly describe to you international trade and investment issues, and also some theories, actually a bit what do you call, detail on theories. Okay, so you, at the end of this lesson, you should be able to understand the motivation for international trade. First of all, we need to understand why countries or why companies engage in international trade. And then we are going to look at some classical country-based theories of international trade. Probably you have seen them before, but in a different context, probably from an economic, economic classes, probably. And also use the firm-based theory or the company-based. So from country-based to country-based to company-based theories of international business, international trade, sorry, to describe global strategies and to describe and categorize different forms of international investment. So there's two main parts to the chapter. Actually, one is international trade, and another one is international investment. And we did cover that in the earlier chapters a little bit. Explain the reasons for foreign direct investment, and summarize how supply, demand, and political factors influence foreign direct investment. So I'm not going to touch very much on FDI. Okay, I'm going to focus more on trade. Okay. So what this chapter does is we want to analyze what the underlying economic forces that shape. Okay, let me just that shape and structure international business transaction, or in a major industry. Okay, so we want to see what kind of factors influence international business trades. And I mentioned just now already to discuss major theories that explain and predict international trades and investment activities. Why we need to understand the theories? Because this will help us to, improve or sharpen our business strategies in terms of export and investment opportunities, and how to react to threats that is posed by competitors, and obviously to be successful in international business. Okay, so we must understand the fundamentals, basically fundamentals to trade activities. Okay, so before we go further, let's ask this question. So what is trade? I think we have answered this many times. What is trade? Sarah, what is trade? Just a quick answer, probably.
It's buying and selling goods.
Okay, buying and selling goods between two different parties or three different parties, or exchange of goods. Okay, and services as well. So don't forget about services. But what is international trade? Obviously, selling and buying at the international level rather than domestic. Okay, which is much much easier when you talk about domestic. Okay, same culture, same environment, same law, and so on. So formally, as a formal definition, trade is voluntary exchange of goods, services, assets, or money between one person, organization, and another. International trade extends that it is this exchange between residents of two countries. Okay, when we say residents, who can be residents? How do we define residents? How do we define residents? Residents of two countries can be individuals, right? Can be companies. Okay, So residents may be individual firms, or not-for-profit organizations can also be considered as residents, okay? Residents or other forms of associations. University also have international trade, okay? In terms of services, okay? Education services. But we look at a little bit of history. Okay, if we do not understand it, we don't look back into history, then probably it's we do not know how it arrived until today. Okay, of course today the international trade is so complex and complicated with so many institutions and organizations that are involved. Okay, but we want to make things try to simplify it a bit. Okay. So why does international trade occur? Obviously, because both parties benefit from the transaction. Maybe some kind of benefits, okay, especially monetary benefits or social benefits, right? So both parties, there must be some value that is being exchanged. If there is no value exchange, then there's no benefit. Then there won't be any trades. So, and we have seen that trade actually have direct and indirect effects on national economies. Can you think of one or two things that actually affecting a national economy? What does economy, doing business with another country? For example, Malaysia have trade with France. Okay, what does it bring? For example, Malaysia buy some, some products. What's the effect on us? On Malaysia, for example, or effect on France, for example, what happens? Alban, just one or two.
There's an incoming or an outgoing amount of currency, of local currency.
Currency, in terms of currency exchange, okay, which eventually, when you have, what does this produce to the economy? At the end of the day,
add value to the economy.
Add
you
value.
sell products to the
you create new jobs. You create growth. You create newer opportunities. Sometimes the the knock-on effects. For example, you supply military aircrafts or military equipments to Malaysia. So we benefit by having that capability of not being hostile, but at least be able to have equipments that can defend ourselves. Okay, so we have that. So there are many of course direct and indirect effects on national economic growth, development, the building of the highest building. You remember, Malaysia has the twin towers, the KLCC. Do you know? We have the twin towers. Sarah, you don't know? We have a twin towers. It was the highest building in the 1990s, 98, I think, 97. One of the building is we don't know, Sarah. It's quite sad that you don't know. Okay, I will tell you that we are not we are not that bad actually, Malaysia. So this is the twin tower. You should come to Malaysia and see this. It was I think Alban knows. Alban, do you know?
I think I already saw that.
Yeah. One of this tower, there was a race between building this. One was built by the Japanese. I don't remember which one. And one was built by the Koreans. So there's the race. But this is foreign built, and of course, the technology transfer in terms of construction, high-rise building. It's not easy to build high-rise building, right? So that technology was actually acquired, So that's the effect. And of course, Petronas. Petronas own this building. Petronas is our, national petroleum company. Okay. Right. Back to this. Sorry, Sarah. Just showing you. Okay. And spark additional economic activity in domestic economy, and of course improve competitiveness in terms of imports can pressure domestic producers to cut prices. Okay, if not, the local producers will keep on rising the prices. There is no competition, so there should be some fair amount of competition. Okay, so we look into some of okay, this is just some statistics of international merchandise trade in 2017, 70.7 million, and in terms of services is 5.3. Basically, what it's saying is that there's a huge amount of international trade going on, okay, in terms of goods and services all over the world. And the source of this world's exports, okay, exports, is basically Europe and EU 33%, EU okay, Norian, no problem. US 8.7%, and so on. So you can see the source of world's merchandise exports, okay, is huge. So the significance of international trade has led to the scholars, academics, to develop theories to explain and predict forces that motivate trade. So we want to know these theories. We want to just have an idea what the theories are, and so the government, when we have theories that predict these forces that motivate trade, we can use these theories to design policies that can benefit the country. Either we want to have protectionism, or we want to allow, what do you call, free trade. So managers use theories to identify promising markets and profitable international strategies. So companies can use these theories to actually design their international strategies. Right. So what are the trade theories? It's divided into two. Okay, one is the early country-based. Okay, country-based theories. So country-based theories are focused on individual country and mainly exports and imports. And it is useful for describing trade in commodities especially. Okay, so commodities such as oil, sugar, lumber, minerals, etc. Okay, so these are commodities. And of course, when trade occurs, export and import occur between two countries, price is the most important component. Okay, between when they want you to exchange of goods and services. Okay. So the next set of theory is the firm-based theories. Okay. Have you come across this before? Firm-based theories and country-based theories, Alban?
I don't think so.
Don't think so. Okay. So, okay, this is just a kind of like introduction. Okay, introduction. So the firm-based theories was developed because of the growth of firm, especially multinational corporations. So these theories focus on the company's role rather than the country role, and it is actually useful when describing what we term as differentiated goods. Okay, so what do you mean by differentiated goods? So these are automobile, consumer, electronic, these are differentiated goods. Undifferentiated good, probably is also the commodities is undifferentiated. So differentiated good, brand name is an important component of the customer's purchase decision. Okay, so it's not the raw material. It's like consumer electronics like handphones, like washing machine and so on. So this is the focus is that it's firm. It's not country. Right. So we'll go back to a little bit of history. So the first classical country-based theories is known as mercantilism. Mercantilism, okay? It is actually, it arose during the great European nation states during the 16th century. It's the economic model at that time, okay? Whereby countries' wealth is measured by the amount of bullion, okay, maximizing holdings of gold, silver, and so on, okay. So when they export and import, they use gold and silver as the medium of exchange, okay. And during this stage, the pro-mercantilism they want to promote export. They try to export as much as possible and minimize import as possible. Okay, so when they promote exports, they actually provide subsidies and tax rebates for their domestic industry or domestic firms. They discourage imports by imposing tariffs and quotas on imports. So they try to actually reduce that what do you call flow of gold outside their country. So they try to hoard, not to hoard. They actually keep gold. Okay. So that was the time. It was, it seemed to be a sound economic policy at that time. Okay. Right. So most members of society, however, are hurt by such policies. Okay. Because this doesn't actually create efficiency or competitiveness. So because it doesn't affect society, but even today, there are still the the modern supporters of mercantilists or protectionists. We call is actually protectionism. Okay, protectionism. So they even until today, US also have policies that try to protect their domestic industry, and nearly every country actually has adopted some kind of neo-mercantilist policies to protect key industries. Japan, for example, limit import of rice 10%. Okay, so and recently, I think Indonesia banned the export of palm oil. I don't know, they have relaxed that. Okay, I think 2 weeks ago. You heard about it? Because there seems to be a global shortage of vegetable oils or vegetable oils. So they try to, and there's an increase in the price. Okay. Last year also, US imposed tariff on China steel imported into US. So that is trying to protect. But the medium of exchange is of course what do you call currency today. But this time it was all based on gold and silver. So so this this mercantilism, okay, was attacked by Adam Smith. Adam Smith attacked the intellectual basis of mercantilism. He argues that it weakens a country, it squanders a country's resources, and I mentioned just now, it result in inefficiency. So it reduces a country's wealth, and there is inefficiencies in this kind of trade system. Okay, it robs the individuals of the ability to trade freely and to benefit from voluntary exchanges. Okay, so that's the idea. So he advocated free trade among countries. Okay, as a means of enlarging a country's wealth. That means there should be, free exchange of goods and services between countries, and countries must not try to block, okay, or limit the exchange of what do you call goods and services, okay, especially goods. What do you call the what do you call commodities, okay, commodities, right? But the problem is the question is this: which goods to export and which goods to import? Okay, so if it is a free trade between countries, between two countries, for example, what should no country A export? What should country B export? Or vice versa, import and export. So in order for both to gain, okay, in terms of especially, you know, what do you call productivity or even effectiveness, okay. All right. Is my internet line a bit slow?
No, it seems fine.
Okay. This is so Adam Smith developed this so-called theory of absolute advantage. So this theory says a country should export those goods and services for which it is more productive than other countries are. That means it is if it is more productive to produce in country A, then export that. And import those for which other countries are more productive to produce them. It's a very simplistic, view, simplistic view, theory of absolute advantage. It's like this. Okay, so the book gives an example of this. For example, France has an absolute advantage in the production of wine. So you can see here. So the assumption is this: for simplicity purposes, there's only two countries in the world today, for example, France and Japan, only two goods, which is wine and clock radios, and only one factor of production, just for illustration. So labor, output per hour of labor in France can produce what do you call 2 units of wine, okay? Whereas in Japan can only produce 1, right? So in terms of productive, France is much more productive than Japan in producing wine. But on the other hand, for clock radios, you can see here Japan is more productive, okay? So France has an absolute advantage in the production of wine, and Japan has an absolute advantage in the production of clock radios. So if they trade with each other on these two products, both will be better off, okay? So this is the theory of absolute advantage. But there is so both will be better off, okay, if actually they exchange these the goods, okay. If, for example, suppose France agrees to exchange 2 bottles of wines for 4 clock radios, okay, only 1 hour of French labor is needed to produce the 2 bottles of wine bound for Japan. In return, France will get 4 clock radios from Japan. These 4 clock radios would have required 1.33 hours of French. It's basically, your productive labor that should be utilized to a specialized product. Okay, specialization. So by trading with Japan, rather than producing the clock radios itself, France saves 0.33 hours of labor. Okay, and France can use this free up labor to produce more wine which in turn can be consumed by French citizen or traded to Japan for more cloth. It's very simplistic, allocation of scarce labor to produce goods, whereby more productive than Japan and then trading them to Japan. Similarly, in Japan only uses 0.8 hours of labor to produce 4 clocks for the exchange of 2 bottles of wine. So this is absolute advantage, okay? But what if France, looking at these 2 products, France also has, a very efficient, for example, they can produce 8 clocks, okay, 8 clocks for 1 hour. Would there be any trade, Alban, between with these 2 countries? Rather than 3, for example, France can produce 8. Sarah? If France can produce 8, Japan produce 5, right? Would there be any trade between these 2 countries? Alban?
There would be no point for France to trade with Japan, right?
No point to have trade with Japan because so there's this theory has weakness. Okay, there's a flaw in this in this theory. So basically, if one country can produce the products much more productive, I mean, there will be no trade basically. Okay, then we'll move on to what the next theory talks about. Okay, so what if one country has absolute advantage in both products? So the theory of absolute advantage, there will be no trade. So we move on to another theory, which is actually an improvement to that, and it's called the theory of comparative advantage. Okay, comparative advantage rather than absolute advantage, it's in comparison with. Okay, so it's a bit never mind, I'll just go through. So it was developed by Ricardo, and it looks at relative productivity differences, whereby it looks at the incorporates the concept of opportunity cost. Okay, the value of what is given up to get the good, in determining which good a country should produce. Okay, so there is a comparison. So a country should produce and export those goods for which it is relatively more productive than other countries, and to import those goods for which other countries are relatively more productive than it is. Okay, right. So if it is relatively more productive than other countries, then you export that. If it is relatively less productive, so import those goods and services. Just to illustrate by an example, that's what I said just now. If, for example, okay, you have wine for here, 1 year. Suppose productivity stays the same in Japan but doubles in France as a result of a new job training programs. So what will happen? So based on the theory of comparative advantage, trade should still occur. Okay, France is 4 times better than Japan is in terms of wine production, but only 1.2 times better in crop radio production. And on the other hand, also Japan is only 0.2 times as good as France. Okay, and in terms of wine production, 0.83 times as good in crop radio production. So France is comparatively better than Japan in wine production, whereas Japan is comparatively better than France in crop radio production. So so France should export wine to Japan, and Japan should export crop radios to France. If they do so, both will be better off, of course. Okay, but this is looking at the numbers is a bit just purely numbers is a bit difficult to visualize. Okay, right. Let's right. Okay, let's look at giving monetary component inside there, then probably can visualize better. Okay. So the theory of comparative advantage with money, example, still the wine and the clock radios, right? Okay, for example, the output per hour of labor in Japan and France for clock radios shown in the earlier table just now, okay, table 6.2. But we have included 1 hour's worth of French labor can produce for bottle wine at the cost of 12 euros. Okay, that means the hourly wage rate in France is 12 euros. And the assumption also is not written here, is in the book. The hourly wage rate in Japan is 1,000 yen. Okay, 1,000 yen. You can see here, right? One output, and that is equivalent to 1,000 yen. Okay, 1,000 yen. So 1 euro is worth 1,000. So the exchange rate of 120 yen per euro. So you can convert this and you get this. For example, 1 hour of this is 1,000 yen. This is okay. How to get that is actually the cost of goods made in France. So of course, the 3 euros times 125. So you get 375. Are you following? Can you see the numbers here? Alban? 3 times 125 is equals to 375. And so you convert into, the currencies of, one country and the other country. So what should you do now? Okay, what is your, business decision? Okay, Norian, what is your business decision? What product should you import or export? What product you should export to whom? Any ideas?
Like another product or between those two?
Between those two, now we have wine and clock radios. Now we have France and we have Japan. Okay.
I think France should export wine.
Mm-hmm.
They should import clock radios.
Okay. So on the other hand, also, it's cheaper for, a retail company to import the cheaper clock radios to France, and also Japanese, they don't want to pay for, Japanese consumer don't want to pay 1,000 yen for wine made in Japan. Okay, probably not nice also, probably. This is so from this theory, comparative advantage, there will be trade between these two countries, and the countries will actually import clocks from Japan. That means France will import clocks from Japan, and Japan will imports wine from France. Okay, so the theory of comparative advantage with this illustration of including money, actually proves that. Okay, any questions? No, for example, Malaysia exports palm oil because it's cheaper. Okay, it's much more, comparatively more advantage to actually, and we buy probably some other machinery equipments using those monetary gains. Okay, so that is the comparative advantage theory, and it gets a little bit more newer theories, okay, which is the relative tutup. Let me just, can I just stop for a while? Okay. So the next question is, what determines the products for which a country will have a comparative advantage? So what determines the product for which the country will have a comparative advantage? So, so to answer this question, these two researchers, Heckscher and Olin, so that's why they call it the Heckscher-Olin theory, developed the theory of relative factor endowments. So these two economists observe this thing, okay, that factor endowments or type of resources vary among countries. For example, Argentina has much fertile land. Saudi Arabia has very huge amount of crude oil reserve, and Bangladesh has a large pool of unskilled labor. Okay. So imagine we're trying to think which goods or which products to export and import. And goods differ according to the types of factors that are used to produce them. For example, wheat requires fertile land, oil production requires crude oil reserve, and so on. Okay, apparel manufacturing requires skilled labor. So from these observations, so they developed this theory. Okay, so the theory says that a country will have comparative advantage in producing factors that intensively use resources or the factors of production it has in abundance. So a country will, of course, different countries will have different, resources. Okay, they call it factor endowment resources. So this will determine which will import. That's it's very common sense, right? If I have a lot of oil, obviously I will export the oil. But in today's, business sense, it doesn't add. You don't want to export raw oil only, but you may want to actually process that oil and export the processed fuels, for example. Okay. Right. So that, and it is called the pattern of comparative advantage. So differences in relative factor endowments, what happened is that export products that use relatively abundant factors of production and import products that need relatively scarce factors of production. Okay. So they tested this. Okay, that's this model or this theory was tested by empirically by a person called Leontif. Okay, Leontif. So Leontif actually tried to prove this so-called theory. If the country is abundant in capital intensive goods, okay, they will actually export this, and they will import labor intensive goods because of their labor scarcity. For example, labor intensive goods, like for example producing shoes or clothing and so on. Okay. The empirical test resulted into not being able to prove the theory. Okay, so this is why we call it as a Leontif paradox. US imports were more capital intensive than were US exports, and US imports were more capital intensive than were US imports. You understand? That means it's actually against what was actually suggested. Okay. So he used this. Okay, the next. Right. So US should export capital-intensive goods such as bulk chemicals and import labor-intensive goods such as clothing and footwear. So this was this test, the empirical test. And from the study, if you see here, 3.9 million of capital plus 170% hours, person years of labor produces one bundle of 1 million worth of imports. Okay, and no, 2.55 million of capital plus this number of years of labor produces this 1 million worth of exports. Okay, so imports required in that year were more capital intensive than US exports. It should be the other way around. Imports required what we call $4,201 more in capital per person of labor than to produce the export did. Okay, so this is what we call as the relative factor, the Leontif paradox. Okay, so the theory was not able to be proved. Okay, but of course scholars argue there must be reasons why it was not being able to prove. Results so were not consistent with the prediction of the theory. US imports were 30% more capital intensive than the exports. Scholars argue measurement problems flaw. Okay, Leontif assumed two homogeneous factors of production, labor and capital, whereas other factors of production exist. So the the measurement probably have some error. Okay, human capital, technology, all these are other factors of production which were not included in his analysis, Leontif's analysis. But anyway, this these are theories. Okay, these are theories in which trying to show the benefits or the values of country-based, country trading with each other. Okay, because at the end of the day, you must gain benefit by doing that, by trading within countries. Okay. All right. Any questions? Those are country-based. Okay? Country-based. Country means between one country to another country. Right. Okay. We'll move on. So to the modern firm-based trade theories. Okay, why firm-based theories were developed? Reasons why firm-based theories were developed: because the growing importance of multinationals in the post-war international economy. Now, rather than looking at countries importing, exporting, selling, and trading, the interests were now on firm-based companies doing business in another country, investing in another country. Okay, especially the growing importance of MNCs, and the inability of country-based theories to explain and predict the existence and growth of intra-industry trade between industry. Okay, between the different industries. And also the failure of Leontif and other research empirically validate. So that's why a lot of research today are firm-based theories, using firm-based theories. Right. So the firm-based theories now, because you're looking at more micro level. So it will incorporate factors such as quality, technology, brand name, customer loyalty into explanation of trade flows. So the newer theories will explore the firm's role in promoting exports and exports between countries. Okay, so it is much more detailed, as well as it is trying to look at how, for example, Intel, or for example, how, you know, Toyota, or how BMW, how the automotive industry, you know, functions, or the electronic industry, what do you call, doing trade with other countries. Okay. Okay, the first theory is was developed or created by Raymond Vernon. Okay, created firm-based theory of international trade, where he traced the role of innovation. So the concept of innovation influences trade. Okay, market expansion also influences trade. Comparative advantage is included. Strategic responses of global rivals, international production, trade, and investment decisions. So it is not simpler, not not as simple as what the country theory has assumed. So Vernon suggested that international product cycle consists of 3 stages: new product stage, maturing stage, and standardized product stage, which will determine, what what kind of trade will happen. Okay, whether imports or exports. So this can be shown in a simple graph. Okay. Can you see it's actually stage 1 is new product. Okay, stage 2 is maturing product, and stage 3 is standardized product. It actually is broken down into 3 types of countries. Okay, less developed countries, other industrialized countries, and innovating firms countries. So there is this if we look at innovating firm countries first, okay, you can see here that the first stage is a new product. You just produce and consume. Okay, then only you will, in the maturing stage, they will export, and during the standardized stage, there will be a lot of imports back to their own country when it is actually a standardized product. Okay, so let's look at the first one. Okay, new product stage. What does it say? So in the first stage, product life cycle, new product stage, the firm will develop and introduce an innovative product in response to the perceived need in the domestic market. So the main market is domestic. The existence of proprietary market is uncertain because it is a new product. You're trying to make sure the product is selling. So marketing must monitor customer reactions closely and do improvements if necessary. And the firm often minimize its investment in manufacturing capacity for the product and sells mostly to domestic market. So according to Vernon, so basically during the new product stage, there is no trade. There is no trade between countries. Okay, the business is within the domestic market only. Okay. Okay, the book gave example of during the early days of personal computer industry, the small producers that populated industry had their hands full trying to meet the demand for their product domestically. For example, Apple's initial assembly plant was located in the garage of co-founder Steve Jobs. The first large order for its homemade computers, 50 units from a local company hobbyist store, almost bankrupted the firm because it lacked the financing to buy the necessary parts. But it survived. Okay, because it was located in Silicon Valley. So it was a perfect location for Apple sales to grow from 0 in 1976 to 7.8 million in 1978 and 229 billion in 2017 local business. Okay, and if you move on to the maturing stage, it gives Apple as an example as well. Okay. So the demand the product expanded dramatically, and the innovating firm will build new factories to expand capacity to satisfy domestic and foreign demand for the market. That means during the maturing product stage, the products will already been sold what do you call in a foreign market. Okay, and so domestic and foreign competitors begin to emerge. So there's now starting to be a competition. So in the case of Apple, the company introduced a hand-assembled version of its second model, the Apple II, in the spring of 1977. Within 3 years, it sold 130,000 units. It's typical of the successful company, of innovating companies. And they build, foreign to serve domestic and foreign customers. Apple II were manufactured in California and Texas and distributed from warehouses in US and the Netherlands. So export begin. Right. So you can see, that once it's matured, then and once it reached the standardized product stage, the product become more of a commodity. And in order to lower manufacturing costs, the firm will shift production to countries with low labor costs, and as a result, they won't be producing in their own country anymore. They will just begin to import into the innovating company's home market by either the firm or its competitors. Okay. In some cases, imports may also result in complete elimination of domestic production, as seen in many developed countries market, US or even Europe. Okay, so the product have reached a standardized. It's a commodity. It's no more innovative. What do you call? That needs to be protected. Okay. Any questions? Product life cycle theory in terms of doing trade with countries, but this is export and imports. Of course, there will be times in which they will build facilities in the host countries as well. Okay. Right. So we move on to the other theory, which is the country similarity theory. Okay. Before that, okay, we need to differentiate between inter-industry trade and intra-industry. Okay. So the country-based theories were actually suitable for explaining inter-industry trade among countries. Inter-industry is actually exchange of goods produced one industry in country A for goods produced in different industry. For example, wine and clock, electronic industry, and so inter-industry. Country-based theories cannot not predicted in country theory. Intra-industry trade between two countries of goods produced by the same industry. For example, automobiles. Automobiles are intra-industry trade. For example, Germany produces BMWs exported to Japan. Japan produced Toyotas exported to Germany, to US. So these are intra-industry, and this is not cannot predict by the country theory. So in this country similarity theory, the theory states that most trade in manufactured goods should be between countries with similar per capita incomes, and that intra-industry trade in manufacturing goods should be common. Okay, so if they have similar per capita incomes, then intra-industry trade will be flourish, will be accepted and being what do you call done. Okay. That's why it is useful in explaining trade in differentiated goods such as automobiles, expensive electronics equipment, personal care, for which brand names and product reputation play an important role. Okay. Undifferentiated are those consumables, coal, petrol, sugar, brand names are not important. Okay. So this is focused on differentiated goods. Okay. So that's the theory only. It says that there will be a trade between intra-industry what do you call differentiated goods. Okay. Same stage of economic development. So Stephen Linder, okay, the person who actually proposed this theory. In his view, companies initially manufacture goods to serve the firm's domestic market. As they explore exporting opportunities, they discover that the most promising product markets are in countries where consumer preferences resemble those of their own domestic market. Okay, of course, it will. You have to make sure that they actually, can afford it. Okay, for example, BMW. BMW is considered as is it a luxury car in France? Can you say that BMW is a luxury car? No. Oh, okay. What about Mercedes?
Maybe
no.
a bit more,
Huh?
but not
Not
luxury.
really,
But
okay. But in my country, BMW, Mercedes considered as luxury cars, expensive cars, which can only be bought by rich people, okay, or people who have money. Okay, so that is country similarity theory. Next one, new trade theory. Okay, the so-called new trade theory was developed by Helpman, Krugman, and Lancaster. Okay, so in 1970s and 80s, Linder's analysis by incorporating the impact of economies of scales on the trade of differentiated goods. So economies of scales come into the picture of differentiated goods. So he predicts that inter-industry trade will be commonplace, and economies of scale occur if a firm's average cost of producing a good decreases as output of that good increases. Economies of scale. Right, there is a difference between economies of scale and economy of scale, right? So economy of scale is as you produce more, the goods become cheaper. Okay. For example, many automotive manufacturing companies benefit from this economies of scale. If both BMW and Toyota are able to expand their sales beyond the home market, each will benefit from lower average costs and will improve competitiveness against smaller firms. Okay, so for example, in industries in which economies of scale are important, we would expect companies to actually aggressively expand beyond their domestic market. That's why the automotive industry is very, very competitive, or even the electronic goods industry are very competitive. Samsung today is a brand name in electronic industries. It was not a brand name in 1980s. Samsung, yeah, Samsung, or even LG. Do you know what LG stands for? Lucky Gold Star. Okay. It was used, so economy of scale come into the picture. And so in trying to obtain a sustainable competitive advantage in this new trade theory, okay, it says that the firms competing in global marketplace, there are 4 ways in which to sustain their competitive advantage. How to sustain your competitive advantage? When you go global, you have to sustain your competitive advantage, right? Number 1 is obtaining, owning intellectual property rights. Okay, this is true until today. If you do not have any intellectual property rights, I mean patents or your own technology, you will actually be losing. So intellectual property is actually a firm's owns intellectual property, trademark, brand name, and so on. Okay, right. So do you have to have you own your IP? You invest in R&D. Obviously, if you want to own IP, you need to invest in R&D. R&D, especially in high-tech products, are very expensive. Okay. So because of large entry costs, firms often hesitate to compete against established firms. For example, in defense industry, so it's very difficult for developing country to actually spend a lot of money like developed countries, okay, like US or France or US or UK. Okay, Malaysia cannot compete with countries that produce aeroplanes, for example. We cannot. Okay, the investment in R&D is huge. It's too much, right? So that's of course achieving economies of scope. Okay, just now it was scale. Scope is actually in terms of type. Okay, type of product. So the difference between economies of scale and economies of scope is that the different what do you call number of different products that you have. Okay, that's why Toyota. Do you know that Toyota also produces what do you call marine products, jet skis and so on? Do you know? So it's actually in synergy with what they actually have in terms of transportation, right? Transport. They have a company that produces trucks as well. They have trucks, they have produce bus, they have cars, but they don't have motorcycles. Toyota doesn't produce motorcycles like motorbikes, like BMW. BMW produces motorbikes. This is achieving the scope, economies of scope. Right, and so this is actually scope and exploiting the experience curve. Okay, experience curve. So another source of firm-specific advantage in international trade is actually exploiting your experience curve. Certain types of products, production costs decline as you gain more experience in manufacturing the product. That's obvious. Okay, as you acquire new knowledge and know-how, of course, you can do it faster, cheaper. You don't cut corners, you can do faster. Right. So experience curves may be so significant that they govern global competition within industry. I don't know about your opinion, but I don't think Tesla is a good manufacturing company. It's a technological company, but it's not good in manufacturing compared to Toyota. It doesn't have. I don't know, Alban. What do you think? Do you think Tesla has that experience curve of manufacturing?
Yeah, no, they are an high-tech company, but not a proper car company. Like they're not manufacturing their car like Toyota is. Like at the beginning they were renting, I think, factories and stuff to manufacture that car.
So that's why they
And
have a
they
lot
were
of
not.
safety issues, and they produce cars, and there's a lot of accidents, safety issues, because manufacturing a car requires a lot of past knowledge being transferred to the next generation. That's surely, BMW will have that experience much more than, probably similar to Mercedes or even Toyota, right? So this, or Ford. Anyway, so this is the new trade theory, and so firms compete, and they need to have these elements for sustainable competitive advantage, right? The other theory, this is the final theory, if I'm not mistaken. Yeah, probably you have studied this before. Porter's competitive advantage, national competitive advantage. Porter's theory of national competitive advantage. Okay. Michael Porter, very renowned business professor, strategist, believe that success in international trade comes from the interaction of 4 country and firm specific elements. So he has combined them into these 4 country and firm specific elements. National competitive advantage. The first one is factor conditions. So factor conditions are the land, the labor, and the capital, and including educational level of the workforce and the country's infrastructure. So factor conditions in that country. Okay. So beyond the basic factors of land, labor, and capital, you need to actually consider educational level of the workforce, skills. So educational will result into skills. So his work stresses the role of factor creation through training, research, innovation. You can create the factor. For example, educational level. Can you create, high tech, educational level? So you can, okay, because human beings. Japan doesn't have any land, not much land. They don't have abundant land, so they cannot rear what do you call, sheep or cows. Okay, they don't have labor also, right? So national competitive advantage, number 1 is factor conditions. Secondly, he adjusted demand conditions. Okay, demand conditions. The existence of a large, sophisticated consumer base often simulates the development and distribution of innovative products. That means there's demand. The demand is good, or there is a demand for certain product, high-tech products, which doesn't exist in other markets. Okay, so demand conditions. And of course, it depends on the culture and so on. Okay, so in meeting this demand, the companies will develop and will engineer, design and fine-tune so that it can be marketed internationally. Okay, so demand conditions. For example, Japanese consumer electronic products benefit internationally because the willingness of Japan's large, well-off middle class to buy the latest electronic creation of Sony, Toshiba. But you won't believe me, if you go to Japan, you won't find some of the products that actually they don't sell it overseas. Sometimes, you wonder their local demand is already sufficient to support that particular product. Okay, so they don't sell that overseas. Or everything in France also, certain product you don't sell it overseas, you only find it in France. Okay. It's 11 o'clock. Do you want to take a break, or you want, let me just finish a few more slides and take a break after that, then you can go for the test, right? Okay, I think you can understand this. Related and supporting industries, existence of a large sophisticated consumer base, similar development of distribution of energy products. Oh, sorry, this is there is related industries, and then firm strategies, structure, and rivalry. Okay, so companies will overcome vigorous domestic competition by reducing costs, boosting product quality, raising productivity, and developing innovative products. Okay, and the company will develop skills needed to succeed internationally. And investment made in domestic markets are transferable to international markets. So this is the national competitive advantage theory of Michael Porter. Probably you have seen this before in some other strategic management, what do you call, topic. So what I've shown you just now is this. So the summary of the trade theories. So you can see that there are country-based theories, there are firm-based theories. The unit of analysis is country, and the unit of analysis is firm in this firm-based. Okay, it is important, right, to understand the differences. Okay, so this is the theories. Now, another part of what do you call the overseas investment, okay, the international investment, the trade and investment. Okay, the types of international investments, foreign portfolio investments, which is the passive holdings of securities in terms of stocks, bonds, or whatever, and also foreign direct investments, whereby you acquire foreign assets for the purpose of controlling them, and of course you build factories or you build ports or whatever. So it is obvious that the growth of FDI is very high, but there is probably the graph will drop 2019 because of COVID. This is the world amount of FDI by recipient, stock of foreign direct investment by recipients. So there is a concept called clustering of firm within industry, which is agglomeration economies, where when you increase the number of firms within a given area, the cost of production will decline. Okay, let's look at France. Okay, Champagne and Burgundy. Okay, this is clustering of wine industry. Okay, right. So all over the world, you create this, or even the Silicon Valley is an example also. The FDI, sources of FDI, these are sources of FDI in US and the destination of FDI from the US to countries, for example, Netherlands is 936 billion. Okay, let me check whether it is, yeah, billion of dollars. Okay, it's huge. Okay, the first international investment theories is the ownership advantage theory. Owning an advantage, superior technology, well-known brand name, economy of scale. So this become the motivation of why actually companies invest. So the theory suggests that a firm owning a valuable asset that creates a competitive advantage domestically can use that advantage to penetrate foreign markets through FDI. Okay. Another theory is the internalization theory. Okay, this you must decide whether it is better to own or operate his own factory overseas or to contract with a foreign firm through franchising, licensing, or supply agreements. So this based on transaction cost. If it is low, it's better to internationalize. If it is high, it is better to internalize. Okay, so FDI is more likely to occur, foreign direct investment. In this case, is franchising, licensing, and so on. So the transaction cost is defined as the cost of entering into a transaction. That is those connected to negotiating, monitoring, enforcing a contract, and so on. Okay, if it is high, then then the theory says FDI is more likely to occur. Okay. And the Dunning's eclectic theory, FDI will occur when three conditions are satisfied: ownership advantage, location advantage, and internalization advantage. Okay, so three things: ownership, location, and internalization. Right. So what are the factors that affect FDI decision? There's so many factors actually. There's so many factors that affect FDI decision. But it's broken into three main factors, which is supply factor, demand factors, and political factors. In the supply factors is production cost, logistics, resource availability, access to technology. But access to technology can be, you can bring your own technology or you can buy the technology. Demand factors, customer access. Some countries may limit the customers' accessibility. Marketing advantages, like China blocks some applications to be used. Like, okay, they cannot use Facebook or in China, so you cannot penetrate that market. Marketing advantage, exploitation of competitive advantage, as well as customer mobility. Another difficult area is political factors, okay, because it will become a decision whether to undertake FDI or not whenever the political it doesn't avoidance of trade barriers, okay. So companies actually build foreign facilities to avoid trade barriers. Harley-Davidson built a factory in India to avoid the country's tariff and taxes. Even Toyota also built in US to avoid the quotas. Toyota built a factory in Kentucky because of the quota, a limitation on the number that can be imported into US market, right? So avoidance of trade barriers. And also economic development incentives, political factors that actually, if there are incentive package, for example, the state of Alabama provided 700 million US dollars to Toyota to locate their 1.6 billion factory there, okay, in Huntsville, Alabama. And they created 4,000 new jobs, or they produced 300,000 vehicles. Toyota and Mazda actually, okay. So countries will use whatever resources they have to actually attract foreign direct investment, okay. And of course, political stability is one thing. Political stability.